If you are living in the UAE and wondering how to make your savings grow faster, mutual funds might be your smartest move. Whether you invest a lump sum or go with small monthly SIPs, mutual funds help you build wealth even if you are not a finance expert. In this video, we will show you exactly how to invest in mutual funds in the UAE, what options you have, and the real examples from Emirates NBD and Sarwa. A mutual fund is basically a money pool. Your money combines with others and professionals invest it into stocks, bonds, or other assets. So instead of tracking markets daily, an expert does it for you. If you already have savings ready, you can invest through the lump sum method. A one-time investment, say 10,000, 25,000 or even 50,000 dirhams. One of the well-known banks in UAE is Emirates NBD. At Emirates NBD, you can start a lump sum investment directly through their ENBD app, which lets you invest in over 232 mutual funds from global managers like BlackRock, Fidelity and PIMCO. One of their popular funds, the Emirates MENA Fixed Income Fund, reported a 9.12% year-to-date returns as of September 2025 and has averaged around 6% annually since inception. Another, the Emirates Islamic Money Market Fund, has shown 3.19% year-to-date returns and around 2.8% last year, providing a Sharia-compliant lower risk option. With these kinds of choices, you can tailor your risk and return. The more risk you can take, the higher your potential rewards. Just remember, markets can fluctuate. Key is to stay patient and see the picture in the long run. If you don't want to invest a big amount all at once, no problem. You can go with a systematic investment plan or SIP, where you can invest small amounts monthly like 500 or 1000 dirhams. At Emirates NBD, you can start a monthly plan with contributions as low as 2000 dirhams per month for 36 months term, and you can add lump sum anytime. This makes it ideal for salaried individuals or beginners who want to build wealth steadily. The beauty of SIP is dirham cost averaging. What does it mean? It means you can buy more fund units when prices are low and fewer fund units when prices are higher, balancing risk over time. If you prefer a digital first, paperless route, platforms like Sarwa make it very easy. Sarwa calls itself a financial platform that lets you invest, save and trade in one place. You can build your own monthly investment plan in just minutes. No financial advisor needed. They estimate that a well-diversified ETF portfolio could deliver 3% to 8% annual returns depending on risk level. And according to reviews of their Islamic portfolios, 3-year annualized returns have ranged from 5.4% to 8.9%. Pretty solid for long-term passive investing. Sarwa is perfect if you want simplicity. Everything is automated with transparent fees and diversified exposures across global markets. If you want to know more about Sarwa, just type Sarwa in the comments and we will try our best to make a separate video for Sarwa app. So how to start investing in UAE into mutual funds? Getting started is easy. You just need to open an investment account, any of the bank like Emirates NBD, FAB or a digital platform like Sarwa. After opening an account, you have to complete your KYC using your Emirates ID. Then you choose the fund type, either equity, which is very high risk, but also the returns are higher, then fixed income or the balanced. Then you decide either you want to give the lump sum or SIP, or you can combine lump sum or monthly investments. Then start investing and stay consistent. This is jam-packed, simplified UAE finance for you. Don't forget to like, subscribe and share for more real-life money tips from the UAE. Take care.